All right, welcome everybody. This is You've Got Options for Income Navigator. Today is September 19th, 2024. We're going to look at a few positions that we have on. We're going to talk about potential adjustments, talk about some ideas about what we can do to adjust our positions and maybe add some positions going forward. But right now, what we are looking at is a position in CL. This is oil futures contract that is out 57 days. This position has been on for 6 days. So this position was put on 6 days ago when oil was not doing so well. I know I have posted in Discord a chart with few indicators to highlight levels where we are seeing some oversold conditions. And again, if you want to put on a trade where we are oversold, you want to lean bullish. And, looking at the chart here, we're in no way super bullish in oil right now. Why? Because as you can see in the last, let's just call it since July, right? We're making a series of lower highs and lower lows. We have not taken out previous previous high. So and the previous high right now it's at about 77, right? Oil right now sitting at about 72 or so. So we got some ways to go. We are popping above the 8 in 21 EMA, and we are still below 50 SMA. So to me, in the grand scheme of things, I think that we are near term bearish. We're still trending lower. If we zoom out just a little bit, we're just kind of in the middle of nowhere. All right. So, um, in the last couple of weeks, I had one position that was kind of in trouble. Not really. I haven't reached my stop loss, but I did decide to roll my position down and out, and I ended up in a November 15th position. This is what it looks like right now. Sure, it has recovered quite a bit. I have a tail profit above about 63. So anything above 63, I'm in good shape with 57 days to go. What I don't like about this position is the fact that my T+0 line is pretty steep to the downside, meaning that, prices of oil can revert. And, looking option at Explorer, because we're trading two different futures contracts. We started with one future contract and then rolling into another one. So the chart kind of looks a little weird. But if we were to pull back, as much as 10%, you can see that the slope of my T+0 on the downside is, it's fairly steep. So that in the event that oil pulls back 10%, if we go down to about 64, right? Um, I'm not even anywhere near my trap, but you can see that the losses are going to accumulate, fairly quick. So I'm not a big fan of that. Um, but looking at the other position that I have on, right? This position is only about 6 days old. Also, pretty good spot with about halfway to the tail profit. And again, over the next 57 days, here's my thinking, right? What am I going to do if we pull back down to 64? So in this second position that's only 6 days old, if I pull back down to about 64, again, I'm just entering the trap, but my T+0 is really going to take a dive and will put this position, kind of under pressure. So maybe, right, just maybe, and again, I encourage everybody to think about their positions looking from a portfolio point of view, right? This is what both positions combined would look like, right? So I'm long about 186 delta in oil. So maybe I can add one more position since the last position that I took was 6 days ago. Maybe I can take on another position. And, I typically like to start my positions at about, 60, 70, 80 days out. We have the December 16th expiration, which is 88 days. And I think it's a really long time for something like oil. I prefer these longer duration trades for something like S&P 500 or the ES. But with oil, this may work. Or maybe we can squeeze one more trade in the 57 DTE. And let's see if we can possibly model something that would align with our near-term outlook. Again, so if your near-term outlook is neutral to slightly bearish, right? Again, this chart doesn't tell us a whole lot. We're just trying to rally to maybe 74, 75, which is where the 50-day SMA is. Maybe what we can do in the 57 DTE, which is the 15th of November expiration, maybe we can set up something like a 111, right? And what I would do is, again, 111 would be constructed with a one put debit spread financed by a one farther out of the money naked put, right? So we are taking on additional risk by selling far out of the money naked puts. So do be aware of that. And if that's not your game, then you definitely need to consider that. Let's see what maybe buying a 67. I don't want to overlap my position with the most recent position. So maybe buying a 67, selling a 65, put debit spread. Right. Again, I'm going to pay a debit for this. Right. This is going for about a 30-cent debit. That's going to reduce my tail profit by 30 cents. That's going to also increase my potential reward inside of the trap. And it's going to also relieve some of the buying power. So you don't necessarily have to do a 1-1 anything, right? If you think that oil has run up and now we're going to pull back, you can possibly look at doing something like buying a put debit spread to kind of hedge your two 1-1x positions. Just an idea. I'm not sure if this is right or wrong. There isn't right and wrong, so to speak. But what this will do is this is, looking at the Greeks on the bottom left, that's going to take my net long delta from 118 to about 79, which means that if we continue higher in the prices of oil, right, we're not going to get as much reward because we don't have as much delta. We're definitely going to benefit a little bit more if the price pulls back a little bit, but slowly, right? Pulls back slowly towards the trap. Again, I'm going to say this, and uh, I think members in our community are looking for definitive answers. Do A or do B. There is no A or B. You have to do what's right for you, right? If you think oil's going higher, then maybe instead of doing a 67, 66 debit spread. Maybe you want to sell with, this is going for about a 30-cent debit. Maybe you sell one put at about 30-cent debit, right? So this isn't going to change your tail a whole lot, but it will give you a little more potential reward if the price of the underlying asset is going to pull back over the next 57 days. All right. So if you do, uh, and this is what it looks like, if you do a 67, 66 put debit spread financed by a 55 half uh, naked put, selling one 55 half naked put with 167, 66 put debit spread for close to zero, right? You don't want it to cost you any more other than additional margin that you would have to put up with your broker, right? It's not going to cost you. So you're not really gaining anything to the upside. It just kind of gives you a little bit more protection on the downside. It does increase your net delta to start with. So you definitely want to be um, bullish near term on the price. And this is what adjusted risk graph would look like. But then if we wanted to look at what this would look like in about 20 days from now, you can see that if price is going to become more stable and we're somewhere maybe between 72 and 74, not much change in your potential payout, but our T plus zero is going to definitely change a lot. And this is what combined to risk graphs would look like. I said I think that's not a terrible idea, only because we're not out of the woods in oil, right? We got a nice bounce. Our positions were, we have improved quite a bit. We're now just trying to get above 8 and 21, but we're still in this sloping downtrend, and that's why I would probably take a position where I don't really gain anything on the upside, and I definitely have a little bit more reward on the downside. And if I can do this trade for close to break even, right? If I can put this trade on and pay no debit or no credit, I'm not collecting anything in front, but I'm not really paying a debit. So it's not really costing me anything other than uh, having to put up additional margin to put this trade on. That's not a terrible idea. Right. So that's for CL. And if you're super bullish oil, then maybe instead of selling one 55 half, you can go down and sell a 51 2 of these at 51 strike. And nah, again, just looking at this, so you're not really collecting a whole lot of, you know, for this 112, buying a 67, selling a 66, and then selling two of the 51s. This is going for almost zero. So you're not really gaining anything. You're just, you're pushing your risk a little bit farther out, but the risk graph remains the same. You have a little bit more of the potential reward inside of the trap. Right. So that's one idea. Um, for right now, between these two trades, I'll probably just sit tight for the next couple of days at least, just to see what happens. And, using the software, maybe looking out into, T plus 7 days from now, if we move within one standard deviation to the upside, we'll be in decent shape. If we move down about one standard deviation, we'll, probably lose a little money from where we are right now, but we're still not in trouble because we're pretty far away from where trouble is. And trouble is really when we get inside of the traps or somewhere below 65. Right. So that's the idea. That's, again, I'm not going to say this is what's going to happen or what this isn't going to happen. I don't know. You don't know. And your next guru that's telling you they know, they don't know either. Right. But we can just kind of use some tools that we have to kind of plan and see, what we can do to possibly mitigate some of the risk. I think this position that's made up of two tranches is in a really good spot. We're just gonna let things play out. We have positive theta, which means that and this position should technically appreciate in price with every day that passes by. We have positive delta, which means that if the underlying continues higher, we should also benefit from that. And we have negative Vega, which means that if volatility in oil is going to rise, that's going to play against us. All right, so that's for the CL position. Hang on one second. All right. Looks like we are good to go. So let's go back, and what I really wanted to talk about is positions in the SPX, and I have a few of those. And I think that most of you guys that are not, just blindly following somebody else's plan, or if you want to kind of think for yourself, right? You want to be in a position where you get to decide what kind of incremental adjustments you make, and you are in control of your potential outcome, right? This is one of those positions. We covered this last week. Um, this is where we are today. We are in a slightly worse position where we were last week. And I think we can go back to this time last week. Here's where we were. Right. So we were showing a much higher profit compared to where we are today. And that's because, the market has moved up quite a bit, and we already had negative delta last week. Now we're sitting on a position. All right, we're going to wait for Option Explorer to settle down and show us realistic prices. Right. We're only showing about a $900 profit or $850 profit in a position that still has 57 days to go. We've made one additional adjustment by rolling some of the longs down towards the short leg in the put debit spread that brought in additional credit. So now, with 57 days to go, right, let's talk about um, what is possible and what isn't. Um, so if we do remain somewhere, let's say under 5,900, right? Let's round this off. 5,900. We're at 57.25. If we're somewhere under 5,900 inside of the next 57 days, the most we can possibly make is about $4,000 in this trade, which would be ideal, right? And if, let's say, the market pulls back, not crash, but pull back all the way down in excess of 10% over the next 57 days, right? This trade has a potential of making at expiration, about $18,000. Those are all great things that could possibly happen to this trade. However, right, we always want to think about what's the worst thing that can possibly happen here. Well, the worst thing is that the market continues higher, as we have in the last 37 days. We moved just over one standard deviation. So, you can't say that we're moving with such great speed that was not priced in beforehand, right? If the market continues higher, well, I have a problem on the upside. What's my problem? I have about $1,000 problem. And this is a 5 lot that I'm trading in the SPX, right? So, what is my job here looking at this trade? Today, I may do nothing. Why? Well, let's look at the Greeks. My delta is almost zero. My theta is positive, which means theoretically, this position should gain in value as this call credit spread is going to decay, as my short put credit spread, which is really wide, should technically decay, but it probably won't, but it should. It won't, right? And then I have a put debit spread that's going to possibly decay and lose value, right? So I have, if we pull back, I'm in a decent spot. I don't have to do anything. My delta goes from slightly negative to slightly positive. It's just kind of, um, one of those things where you just kind of have to sit tight and do nothing. But my problem here is if we start to break above 5,800, and I'm starting to, even though at 5,800, being net minus 1.75 delta on SPX is not a big deal, right? I don't want to let this trade get too far away from me, right? So I'm going to need to do something. What am I going to do here? And this is an open question for those that are participating here. And if you have some ideas, I have 2 or 3 different ideas that I already thought about. And you should always have 2 or 3 ideas in your head before you make any adjustments. You just need to figure out which one works best given, what is happening in the market. But if anybody wants to chime in and put something out there, we can definitely take a look and, discuss the good and the bad and, how any potential adjustment will possibly affect this position. I'm going to put out my first idea, which would be, and this is probably the simplest or the most simple idea, was to continue to roll my long puts, right? I have a put debit spread here. If I continue to reduce the width of the strikes here, I will collect the credit, right? Because that's my goal. My goal is to collect additional credit. I want to collect additional credit here. So if I was to maybe sell 5 of the 50/80s and roll them down to 50/65, roll them down 15 points, you can see that my net delta went from flat to slightly positive. I increased my theta from plus 66 to plus 74. I definitely increased my Vega exposure, which is really not a bit risk because, if you think about it, if the market was to go down and volatility was to expand quite a bit, I do have defined risk trade and I cannot lose more than what is defined by the width of my put credit spread. So Vega is really not too much of my concern. My concern here is to try to balance my directional exposure and keep my T plus zero relatively flat and give this trade enough time to go by. Right, I have 57 days now. I want to give this thing at least 30 days and maintain the price somewhere inside of this tent so that I can reap the rewards of not only Theta, but possibly short Vega. Right. So, how do I accomplish that? So, rolling down 5 of the 50/80s down to 50/65s, I collect only about 70-cent credit times 5 contracts, so $350 increase in my potential reward inside of this trap, but I still have a problem to the upside, which means that if the price continues higher, I need to either roll my puts down again to potentially collect more credit, right? Or I need to start to maybe look at ways to increase my delta by selling something closer at the money. And I'll show you what that would look like. Let's say today, September 19th, right? If I thought about rolling the 50/80s down 15 points wasn't enough credit, right? It's only about 70 cents. It's not a lot, right? So I said, okay, you know what? Instead of rolling the 50/80s down 15 points, maybe I'll go to 51/50s and roll those down 10 points. Oops. What is that going to do? Well, let's look at the Greeks. Again, the Greeks go from pretty flat to slightly positive. I'm definitely bringing in an additional credit, and the credit here is instead of 70 cents for a 15 wide, it's 50 cents for a 10 wide. All right. That doesn't sound like a good deal, but I'm also, right, leaving a small gap at expiration that if the price was to settle somewhere between 50/80 and 51 um 51/40, this trade would yield zero return, which is not ideal. But again, I'm not trying to hold this thing to expiration also, right? All I'm trying to do is balance my net directional exposure or my net delta to hold it long enough to where I can see about a 10% return on my risk being buying power that's tied up in this trade. So both of these adjustments are really not too terrible, right? They will rebalance the delta. They may take up a little bit of additional buying power, which is not a big deal, right? Or I can just choose to do nothing and wait until we break above 5,800 and then take action. So I do have time. Again, 57 days is plenty of time until expiration, but as the price continues higher, I need to be aware of these levels. So we get above 5,800. I'm going to start to accumulate short delta and I'm going to need to act on this position. That's my thought about this one. Not a big deal. Um, I think I had somebody propose something, um, eliminating all of the upside risk. Like if the market is going to take off, 1% tomorrow, 2% more next week, and so on and so forth, right? Yeah, okay. How about this? If I was really concerned about price going straight up, maybe I can buy five of the 59.20s and then sell five, right? Converting this call credit spread into a inverted call butterfly, and I will just eliminate any of the upside risk. Sure, I'm going to give up some of the potential reward inside of my trap, so to speak, right? Or tail. But then I have a very small chance of possibly pinning 59.20 at expiration. That would be like the worst case scenario. But if the price continues higher, if that's our outlook, that's one thing to consider. Price goes way up. Okay, great. We don't care if it goes below or over the gap. Is what it is. Not a big deal, right? We give up some of the profit inside the tail, but we also remove any potential upside risk, right? So I hope you are realizing that there's two sides, right? There's always the give and the take. What am I giving and what am I taking? What I'm giving is potential reward inside of this um, tail area. That's what I'm giving. And what am I taking? I'm taking all of my upside risk out. Right. So depending on your price outlook, you can structure these trades any way you like and reap the rewards based on your near-term price outlook. I think with 57 days, I'm going to leave this one as is for now and see what happens in the next day or two if the market has follow through to today's action and we start to get above 5,800. I'm going to consider either rolling some of the puts down to collect the credit, or maybe I'm going to buy a call debit spread, pay some money, which will reduce my reward in the tail, but it's going to unlock my risk and actually give me potential reward on the upside. Right? Very flexible trade. One other potential solution to this trade is what if I was just to eliminate completely, right? Get rid of this put debit spread. If we think the market's going higher, there's no reason to hold a put debit spread. I hope everyone agrees here. If I was to eliminate this put debit spread, it doesn't really pay much. Why? Because this put debit spread is at 8 delta. It's not worth a whole lot of money, right? This 30 wide put debit spread is only going for about $1.30. What is that going to do? It's going to bring in $1.30 credit. It still leaves me with upside issue that I need to deal with. Yeah, it's going to change my Greeks from, flat to +3 on the S&P. Not a big deal. All these adjustments don't change our directional risk all that much. That's why I keep saying that there's no urgency to do something today, right? These positions are very flexible over time. You could take your time. If you don't want to sit in front of your computer all day, stalking these positions, this is the type of position you want to be in, where it's like, if it's not today, maybe it's tomorrow. If it's not tomorrow, maybe we'll do something Monday. Very easygoing. You definitely have the time on your side to make adjustments. And there are definitely several adjustments that you can make to improve your position over time. All right, so that's for the November 15th. I have a few other positions. I've adjusted, I believe I adjusted both positions. And, this is something that I really wanted to bring to your attention here. Uh, let's talk about the October 31st, right? This is a put butterfly. We put on this trade 27 days ago. The underlying has moved just over a half of one standard deviation higher. We definitely moved lower, and let's have a look at what this position looked like on, let's say, September 6th. Bear with me while Option Explorer is going to take us back to the 6th. Right, it didn't look so good. Right? The price was pulling back. We were 2 weeks in the trade. We moved about a 1.5 standard deviation lower. Implied volatility has risen. Um, so yeah, we were moving towards the trap. We were nowhere near hitting our stop loss, so no reason to panic. Right? We're just following our plan. If it continues lower, we'll close out. If it continues higher, no big deal. And then if we look at this trade, um, bear with me while I think Option Explorer may be again freezing up and I may need to restart. But the point was that, as the price was moving lower, we moved 1.5 standard deviations to the downside. We're just barely hitting the center of this structure. And yes, this position is at a drawdown, not a big deal. We're nowhere near hitting a stop loss. Now, if we had similar structure without the long wing on the downside, this position would be in a lot more trouble, right? So that's the difference between trading defined risk trades versus undefined or naked options. So I think that for those that don't want to deal with uh, downside risk and holding naked options, going with something like a defined risk butterfly spread is the way to go. Um, I'm going to try to restart. I'm going to try to restart Option Explorer. I'm not sure. Sometimes when I move the graph back and forth, it'll throw some sort of errors on their end and it'll freeze up the whole thing and just mess things up. But if you have some questions in the meantime, this is the time to ask some questions, and I would love to help you guys out and answer some questions. Uh, Tyler saying move 59.10 to 59.20 higher and further out in time. I'm guessing this is about a trade that we just looked at. Hold on. I'm going to restart Option Explorer. We'll get back online and we can continue from there. It's still loading. Hang with me. All right. Looks like I'm back online with Option Explorer. I'm going to share my screen. Hopefully this won't break everything. All right. This should do it. Right. So this is a trade number 2943. This is SPX October 31st. We put this trade on 27 days ago. Put it on for uh, either a small credit or maybe a small debit. I do see that there was an adjustment made on September 16th. And for those that are following along or want to see details of this trade, you can just go to our Discord and put in the trade alerts channel. You can search by the trade ID 2943, and you will see um, any adjustments. But the idea here is, you know, you put the trade on, let it run. If it comes back down, we do nothing. If it runs up, we need to recover some of the potential debit to the upside. And we do so by either rolling the long leg of the put debit spread down to collect the credit. Maybe we're selling out of the money call credit spreads. Here we chose to roll down the long leg of the put debit spread. And for this trade, the breakdown is very simple. The most I can possibly make in this trade is about $1,200 around, right? My risk in this trade is about $25,000. So in the last 27 days, I'm up, just about 3.5%. Do I need to stay in this trade much longer? I don't, right? If I can turn over the same $25,000 every 27 days and make, 3.5%, I'm totally good with that. I hope you are too. You don't need to chase some super high leveraged, ES or MES or whatever, um, people are telling you. Look at your risk to reward, what kind of returns you're getting. And I'm not telling you that, the next 27 days are going to be as great as the last. But if you can, pull off a trade that's showing you about a 3.5, maybe 4% return in 27 days, why wouldn't you take this trade off? We know that, looking at this trade, that we have to hold this trade for another 42 days. And the most that we can possibly make here is a difference between 920 is what my unrealized or 870, whatever that number is. Whatever my current P&L is, the difference between my current running P&L and my max potential reward, which is 1220. So in the next 42 days, I'm going to make an extra maybe $300 just holding this position. I would be inclined to, bail on this trade and set up something else, right? So that's my thought process. Is it the right thing to do? Is it the wrong thing to do? I don't know. But um, we can look at this trade yesterday after the Fed announcement and what it looked like when the market was pulling back. Right? If today we're up about $900, today we're only 570. So at the close yesterday, we're just sitting tight. We don't have to do a whole lot. There's still, reward to be made. There's still a lot of time, but going into today, we have already collected about 2/3 of the max potential reward in this trade, and now we're facing the question, do we want to hold on for the next 42 days to make an additional $300, or do we want to close this trade out and move on to something else? Honestly, I don't think there's a right and wrong answer here, because let's look at it like this, right? And I say, guys, that everybody should think about adjustments to potentially advance your positions. Advance your positions. Everything you do, you should be advancing your positions. If you're not advancing your positions, you're falling behind, right? Sure, we can sit tight and do nothing. I think that over the next couple of days, I'm not sure what the volatility is going to do, but I don't think that this position is going to change much in the next couple of days. I don't think that we're going to get the full tail profit in the next couple of days, because there's going to be some value in the put debit spread, and there's going to be some value in the put credit spread. And the difference between these two spreads is going to show up in our P&L, right? So this trade at expiration is going to give us about a $1,200 profit, but there's 42 days left. So for the time being, it's not going to give us max potential reward, which is $1,200. So we're sitting at, a $900 gain. We're waiting for the last $300. We have to wait 42 days to do, to get to that max potential reward. If you think that you can use, $25,000 to gain an additional $300 in the next 42 days or more, then this is not the trade to hold. Move on to the next trade. Right? Does that make sense? I'm not saying that, there's a right or a wrong way to do it. It's a matter of opinion. Like if you told me like, hey, you're going to, tie up $25,000, and I'm not really sure what this trade ties up right now in a portfolio margin account. Probably, and I wouldn't say it's much less than $25,000. If portfolio margin, looks at plus minus 15%, it could actually look at minus 15%, and it actually could take up more margin than it initially did, because, looking at a minus 15% slice every single day that goes by, and you can see that, let's move. Well, I can't move this maker to minus 15%, but, look at the 4,800 4,800 price slice, right? If I keep going every single day, you can see that the 4,800 price slice continues to move down, which means that my broker is going to ask me for more and more margin with every passing day to continue to hold on the trade. So I think that from a risk reward standpoint, it makes sense to take this trade off and maybe move on to something else. Now, can I do something to potentially improve this position? Yeah, maybe, right? How can I potentially increase my reward on the upside? Right? Maybe I roll the 5480s down 10 points. So I'm going to sell 5, and I'm going to buy 5 10 points lower. Okay. That's great. I'm going to bring in additional $1.10 times, 5 contracts. So let's call this, maybe $600. Okay, that's great, right? My margin is also going to increase. My delta is going to increase. Not a bad idea if you want to continue to stay bullish on the price of the underlying asset. So maybe not closing out the trade, maybe squeezing or pinching the wing of this butterfly to the upside is the idea. But I think decay is going to slow over the next couple of weeks and we're not really going to get the full reward we're looking for. So maybe the best idea here is to exit out. I know we were looking for a 10% return on our margin and so on. And, if we're only halfway there in 27 days with 42 days to go, look, let me put it to you like this. If you are looking for a 10% return in 60 days and you can get half of that in 1/3 of the time, you're way ahead. I hope everybody agrees with that. Right. And if you continue to turn the same margin requirement over, right, I think that makes a lot more sense. If we were going to make 10% in 60 days versus making 5% in 27 days, right? 5% in 27 days, it's about a 68% annualized rate of return versus making 5% in 60 days. That's about a 30% annualized rate of return. So we're about a double of our goal with this trade so far. The key is being able to redeploy your capital and continue to generate this kind of rate of return in order to sustain this kind of increased returns on risk. I think this is very similar to a position that I have on an bear with me, I don't want to break this. This is a position that I put on 14 days ago, right? So that's 2 weeks ago. Let's break down this trade by max potential reward, what's our risk, and where we are today. So first, again, if you do this trade in a portfolio margin account, right, it'll take up almost full Reg T risk. So there's no advantage of, doing this trade in a portfolio margin account. So Reg T risk here is about 16.5. So let's round this off to about 20,000. 14 days in, 1.3 standard deviations higher since we put on this trade. And maybe we can look at this trade. What did it look like on September 6th, right? The next day after I took this trade, the market had sold off. And again, I hope that we don't, I hope that Option Explorer doesn't break on me again. If we go back to September 6th, right? This is what this trade looked like. We had a pullback. In the 1 day, the market had pulled back at 1.78 standard deviation. So we're pulling towards the center of this tent. Not a big deal. We're nowhere near our stop loss. Yes, the trade is at a slight drawdown. No big deal. If the market bounces higher, great. If the market continues lower, we have a stop loss in place. No big deal. Now, we want to look at this trade today. Here is where we are. 2 weeks later, right? The most we can possibly make here is $1,400. We're at about 925, 875. Let's call this a mid price of about, I don't know, 850, maybe $900 profit, which means that we have to sit tight for the next 57 days and wait for the additional, difference between current running P&L and our max potential reward. Kind of hard to make the case that, we should just sit tight and do nothing. Ideally, we can look at, T plus 14. What's going to happen? This trade is going to be worth maybe $300 more. If you think you can make $300 or more with about a $20,000 worth of buying power elsewhere, I think this is a good exit. It's as simple as that. I'm not going to tell you, this is the right or this is the wrong thing to do. I'm just telling you what you can and what you can't do. You can get out, take this profit, move on, and earn, the whatever the difference is somewhere else. Or you can sit tight, do nothing. This is a really good looking position. We can continue to hold it with 57 days. I don't know if there's much more we can do. I don't know. Let's see what maybe rolling the long 54.60 down 20 points. What does that look like? Yeah, that will be great, right? We're bringing in an additional 450 maybe times 5 contracts. So we'll, drive in an extra $2,000 of potential reward, but we're also increasing our risk. If we look at the Greeks, we go from plus 2.6 delta to almost, about 9. So we're definitely increasing our directional bullish exposure. Look, if this aligns with your near-term price outlook, this is a very, very decent adjustment to consider. Just rolling your long puts of the put debit spread down 20 points. If you have the margin to do it, and you're okay with taking a little bit more of the directional risk, that's a decent adjustment. On the flip side, you took on more additional directional risk. What happens if the market goes down 2%? Well, this trade is going to be in a little bit of a trouble, right? So you always want to think about what happens if, you know, things don't, if things go the other way, if things don't go the way you think they are. Because, we are, as humans, we like to think about, all the reward first. But, I want to encourage everybody to think about the risks first. What happens if things don't go your way? What happens if things go the other way? Right. So you got to think. I want to encourage everybody to think. Don't follow. Think. Thinking is key. This is what's going to make you a better trader long term. Thinking about, what if I do this? What if I do that? What's the good? What's the bad? Right? Weigh in your risks and rewards and then make adjustments based on what makes your position better. For me, I'm probably going to just leave these trades as is. Tomorrow's Friday, right? I don't expect a whole lot. Maybe the market goes up another 2%. I don't know. Maybe it goes down 2%. But guess what? If we go down 2%, I definitely don't want to make any moves today. I'm just going to wait it out to see how today's price action is going to shake out. Why? Because I have the time. I have 57 days in this trade. I don't need to jump out and do something. Right? And this is the kind of trade that you want to do if you don't want to be glued to your screens, if you don't want to watch your trades tick by tick and worry about this and that. Right? Very easy to manage. You can look at this kind of trade could be set up. You give yourself enough time, 65, 75, 80 days away, and you just check in maybe once a day. That's it. Once a day. You look at the trade. Do I need to do something? Here's my thought process. If I do this, then that. If I do that, then this. Okay. And maybe you do nothing. And then you move on about your life. Come back next day. Okay, here's where we are. But you always want to know that, if the market was to go down 5% tomorrow, right? You can set alerts on your platform or whatnot. If we're down 5%, hey, let me know. You know that if if the market goes down 5%, your positions need attention. That's when you need to jump in and kind of figure out what you need to do next, right? Anything outside of that, and market doesn't go down 5% every day. Market never goes down 5%. Market does not crash most of the time. Or I should say, most of the time, market does not crash. So if you're going to trade with like this thing in your head that, oh, what if the market crashes? What if, then don't trade. Put your money into S&P 500 and don't look at it for 20 years. But if you want to be proactive, you want to do things, right? You kind of want to assume things are going to move within the standard deviation. So what's the one standard deviation tomorrow? Well, I don't know. Two standard deviations tomorrow, we're going to go down to 56.55 on the S&P or up to 57.91. Okay, as long as we're within this two standard deviation range tomorrow, this position is not going to change a whole lot for you. So you can go on about your life and do whatever it is that you're enjoying doing, and you don't have to, look at your screen, all day long to figure out what's my next move. These are very slow moving, very forgiving, earlier on type of trades. They might take on a little bit more of your capital at first, right? But can you squeeze out 4-5% in a month trading these kind of trades? Absolutely yes. Right. So you don't have to chase some fancy guru selling you some nonsense, uh, trade and make 8% in a month, hedge, whatever nonsense. It's all nonsense. Figure out your risk in the trade, figure out what you're trying to accomplish, and find the best way, right? Find the path of least resistance to your goal. And that's what we're trying to do here. The other trade that I had put on, and this is a slightly different trade. I am long a put debit spread farther out in time, short a naked put near term. Again, as the price moves higher, looking at this risk graph, I'm still positive delta, which is okay. I'm just going to sit tight on it and do nothing until we break above 5,800. My delta goes from slightly positive to slightly negative, and I need to rethink my plan for this trade. But for right now, I do nothing. We pull back, great. If we crash, I have a problem. But if we just pull back, let's just look at, in the next 2 weeks, if we just pull back within the normal one standard deviation fashion, it's not going to, this trade it's just a one lot. But this trade is going to show a decent profit, right? And then I have the front month, which is where my short naked options are. We'll have about 15 days to go. I can consider rolling them out, maybe closing them out, putting on another trade, and potentially building out my longer term put debit spreads that are going to be free by selling near-term options naked to free up the debits that I'm paying for these longer term, right? This is what my longer term put debit spread looks like, way far away, right? But these put debit spreads will keep my near term 112s safe in the event that the market is going to freak out and volatility is going to explode to the upside. And that is my bridge to keeping me from forcing me to close out my positions and continue to embrace the trading plan that Tom King has put forth. And I think that trade plan works. It worked then, it works now, it's going to continue to work. We just need to find something that's going to help us keep our positions a little bit longer. We need a speed bump. A speed bump is something that is going to delay, these forced liquidations that we saw on August 5th. Right. So I'm still working on this. I will definitely share with you guys, how and why and when these work. And I think once we patch this up, the plan we had, it's going to be bulletproof. All right. So these are positions I wanted to talk about, some of my ideas. If you guys have any questions, let me know. If not, we'll move on about our day. We are going to continue these. We'll be back online next week on Thursday, same time, same place. I definitely appreciate you guys tuning in, taking the time out of your day. If nothing else, I'm going to let you run. All right, guys. I will stop the recording.